Hey everybody, welcome to Mortgage Today for Tuesday, July 18th, 2023. And oh, what a day it was. MBS were up 16 basis points on the open. Stocks were pretty much flat. Bonds rallied overnight, almost exclusively due to an even sharper rally in EU bonds. 10-year yields were as low as 3.743 just before the retail sales data, and they rallied just a little bit more after the data, at least at first. There's been a bit of a pushback since then, which is surprising at first glance considering retail sales came in at 0.2 versus a 0.5 forecast. But one of the components of this report often receives just as much attention as the headline. The control group, aka core retail sales, aka retail sales excluding autos, gas, building materials, came in at 0.6 on a 0.3 forecast. Combine this with the 0.2 revision to last month's headline, and the data suddenly looks more economically bullish than the initial headline would suggest. As we talked about, retail sales came in at 0.2 on a 0.5 forecast. Last month was revised up to 0.5. It was 0.3 previously. Retail sales, like I said, excluding those items, came in at 0.6 on a 0.3 forecast. Wasn't much other data today. European bonds set the tone in the overnight session after normally hawkish ECB member made dovish comments on the near-term rate hike pause outlook. German Bunds, still love saying it, rallied a full 10 basis points peak to trough, while U.S. 10s barely managed 5 basis points over the same time frame. The AM economic data in the U.S. created some two-way volatility with the retail sales headline like we talked about. Yields were sideways and choppy until Europe closed the day. After that, they were modestly drift towards but not into weaker territory. All in all, an uneventful day that is perfectly in line with the broader sideways baseline expected between last week's rally and next week's Fed announcement. At the end of the day, net, we were up 5 basis points on the MBS, but stocks gained 32.19 points. So at the end of the day, at 99.75, that puts us, like I said, right in the middle of this thicket of ranges. So we have a floor at the 25-day moving average, which is about 10 basis points, about 15 basis points below where we are right now, and then 4 ceilings with a Fibonacci, the 50-day moving average, the 100-day moving average, and the 200-day moving average. In other news, since 2009, rent prices have grown by 60% and more in 7 U.S. cities. San Jose at 85%, Denver, Seattle, Portland, San Francisco, Nashville, and Austin at 60%. Rent prices are also rising faster than incomes at 60%, yeah, I would imagine, which forces tenants to shell out a greater share of their wages on rent. At 28.5%, Miami has the highest rent-to-income ratio of the 50 largest U.S. cities, while Cincinnati is the lowest at 15.5. The rent-to-income ratio declined in only 4 cities, those being Cleveland, Pittsburgh, Buffalo, and Providence. From our sponsor at WellThatMakesSense.com is do not underestimate your opponent. You gain nothing from underestimating your opponent. Hubris is the only thing that upsets the people on the top of the mountain. When people grow to be mighty in size and all that stuff, it's usually their own hubris of thinking they are inconquerable that makes it possible for you to conquer them. So do not underestimate their hubris and go after them.